Okay, I guess we'll get going and people will join us as we go along. Well, hello everyone. On behalf of Marie Brière and Sophia Ramos, it's a pleasure to welcome you again to the first webinar organized by the ESSEC-Amundi Chair for the 2024 season. I would also like to thank Vanessa Thomas for the logistics. As you know, for those who have been following us, this is the third year that the ESSEC-Amundi Chair is organizing webinars on ESG-related issues. Today's webinar focuses on the incentive of fund managers to incorporate ESG considerations in their portfolio decisions. ESG funds claim that their strategy is based on value creation, which delivers both financial returns and ESG outcomes. Yet, despite increasing research, it still remains unclear whether these sustainable investment policies have a real impact, and the debate remains open as to how investment managers perceive the practice of selecting firms based on ESG criteria and how they expect these strategies to deliver financial performance. The two papers in today's program provide new evidence on this topic. The first paper, presented by Michelle Lowry from Drexel University, raises the question of which funds are truly committed to ESG and examines the motivation of ESG fund managers, showing that not all ESG funds have a significant impact on ESG performance and outcomes. In a second paper, Stefano Ramelli from the University of St. Gallen and the Swiss Finance Institute raises the question of how much personal investment ESG fund managers have in their funds, the objective being to understand the underlying preferences and conviction of ESG fund managers through their investment choices. As usual, participants are encouraged to ask questions on the chat. They will be answered at the end of each presentation. And I'm now turning over to Marie Brière from the Amundi Investment Institute and co-head of the chair, and I wish you a very good webinar. Marie, it's all yours.
Thank you very much, Jocelyn. So yes, it's my great pleasure to welcome you today, together with Jocelyn and Sophia, to our webinar on ESG and incentives of fund managers. There is a large debate in the US about how much mutual funds should consider sustainability in their investment policy. Recently, around 20 Republican states have enforced actions restricting the use of ESG factors. Texas, for example, has directed its state agencies to divest from investment companies supposed to promote ESG causes or to boycott energy stocks. So being a sustainable fund manager can be a handicap today to get business from pension funds in some US states, which consider that funds should focus on their fiduciary duty. But here comes a tricky case question. Is ESG integration a source of outperformance? The question is highly debated and it's subject to heterogeneous beliefs, both within professionals and within academics. Economists have identified several mechanisms through which ESG orientation can enhance firm value, but the historical outperformance partly reflects massive inflows into green assets and does not guarantee future returns. So how do US mutual funds solve this dilemma? This is a question we will tackle in this webinar. So I'm very glad that we welcome two prominent speakers, Michelle Lowry from Drexel University and Stefano Ramelli from the University of St. Gallen. And I would like to thank both of you for your participation, but also thank, of course, Sophia, Jocelyn, and Vanessa for a great partnership between ESSEC and Amundi Investment Institute. Thanks to all of our colleagues or partners to attend the conference, and I hope you will find it useful.
Thank you very much, Marie. The first presentation is by Michelle Lowry.
Okay. First of all, thank you very much for inviting me here. Thanks to the organizers. I'm very much looking forward to this opportunity. Let me just make sure everybody can see my screen. Yes? Mm-hmm. Fantastic. Okay. So with the somewhat auspicious introduction that everything that's going on in the US in particular, this certainly is a critical debate. So it'll be interesting to see where we end up today. So the paper that I'm going to be presenting is called Are All ESG Funds Created Equal? Only Some Funds Are Committed. And this is co-authored with Pingle Wang and Kelsey Wei, both at University of Texas at Dallas. Okay, so in terms of broad motivation, I'm probably preaching to the choir here, but without question, there's been growing interest in sustainability across many investors, both in terms of the dollar inflows into sustainable funds and in terms of the amount that investors are willing to pay for sustainable funds. So a recent academic paper concludes that investors pay approximately a 20 basis point premium for sustainable funds. But an outstanding question is how committed truly are these funds to sustainability? In other words, to what extent do these funds' investments matter? Do these funds influence corporate conduct? And there's been a lot of skepticism regarding this, regarding whether these funds actually have impact. This is a quote from Tariq Fancy, who was the former head of BlackRock Sustainable Investing. He says, the major problem that I have is even if ESG funds are marketed correctly, they actually have no demonstrable impact. So we want to turn that around, so to speak, and we are going to ask, would we expect funds to have impact? And the answer from an economic perspective is that it depends on two fundamental issues. First, it depends on whether fund managers view ESG as a value driver. If they don't, they're not going to seek to change it. And it depends on fund managers' incentives to engage with portfolio firms. And thinking about the second bullet point there, their incentives to engage, we know that funds vary in their incentives to engage with portfolio firms. And again, there's another academic paper by Llewellyn and Llewellyn that sort of demonstrates this from both a theoretical and empirical standpoint. In other words, all ESG funds are not equal. Some ESG funds have strong incentives to engage with portfolio firms, whereas others do not. And I'll talk a little bit more in depth later, but basically funds' incentives to engage are based on the monetary benefits of that engagement. So the question we're going to ask is, do ESG funds with high incentives to engage, do those funds differ from other ESG funds? And in particular, we're going to focus on 4 dimensions on which these funds might differ. The fund's information acquisition around firm ESG events, the firm's investment strategy following negative ESG events, funds' engagement with firms on ESG-related matters, and firms' impact on firms' ESG profiles. Across all of these issues, our overarching prediction is that if these funds view ESG as a value driver, then we should observe differences between those funds with high incentives to engage, that is, committed ESG funds, and other ESG funds. Let me just give you a roadmap of where we're going. Our first step is going to be to categorize mutual funds. We first need to identify what mutual funds are ESG funds. And then within ESG funds, we need to identify those that are committed, i.e. those with high incentives to engage versus all others. We'll then validate these measures, and then we'll go on to our main empirical tests. So let me start by just describing in a general sense how we categorize mutual funds. Our first step is just to classify all mutual funds based on what we call their asset-weighted ESG scores. So we're just going to look at the MSCI rating of every firm in a fund's portfolio. And based on that ESG rating, we're going to classify funds as being highly invested in ESG stocks versus less highly. And those funds that are more highly invested in ESG stocks will classify as ESG funds, and all others are non-ESG funds. In our second step, we're going to divide those ESG funds into 2 equal size slices. Those with high incentives to engage, that is the committed ESG funds, and those with low incentives to engage, which from here forth, I'll just call other ESG funds. How do we classify ESG funds into high versus low incentives to engage? We're going to use two approaches. Our first approach is based on this prior academic literature by Llewellyn and Llewellyn. They develop an incentive to engage proxy. And what their proxy captures is the extent to which an increase in firm value, that is an increase in the value of one of a fund's portfolio firms, the extent to which that increase contributes to higher management fees. And there's two ways that this might contribute to higher management fees. One is through a direct increase in fund value. In other words, you engage with the firm, that contributes to higher firm value, and as such, higher fund value. And the second is to increases in fund flows. And we're just going to use their formula for that. Our second approach is based on, again, another academic paper, Pastor, Stembow, and Taylor, portfolio liquidity measure. And the intuition behind this measure is that lower liquidity is going to contribute. So if a portfolio firm has lower liquidity, that means that there's greater costs of exiting the fund's position in that firm, and as such, higher incentives to engage. And this is based on both the liquidity of the portfolio stocks as well as the extent of portfolio diversification. With both measure, we'll classify ESG funds with an above median incentive to engage as being a committed ESG fund. Now, importantly, these two measures are developed completely independently, but nevertheless, the overlap in classification is 78%. So for that reason, I'm not going to show you results the whole time using both measures because not surprisingly, they're basically the same. I'll just show results with the Llewellyn and Llewellyn measure, but again, conclusions are the same both ways. Okay, so to give you just an overall sense of what our data looks like, we have committed ESG funds and we have other ESG funds. Within both groups, so looking first just at the committed ESG funds, they invest about 40% of their portfolio within high ESG stocks and the other 60% within non-ESG stocks. This is similar across any kind of classification of ESG funds you look at. The ESG funds don't invest only in ESG stocks, they invest in other stocks as well. The holdings in committed ESG funds tend to be more concentrated and less liquid, and this is what gives them these higher incentives to engage. In comparison, non-ESG funds have, of course, a smaller portion of their holdings in the high ESG stocks. Some of our analyses are going to be at the fund family level, and we'll use a similar approach to define committed versus other ESG fund families. Okay, before showing you any of our results on these committed versus other ESG funds, I need to convince you that our approach of defining these two groups of funds is valid. And we're going to use two different approaches to do that. Our first validation test, we're going to compare our measures with this Morningstar ESG commitment level measure. This Morningstar ESG commitment level measure was introduced in 2020, and it's based on the investment process and active engagement of funds on ESG issues. And so we look across all funds that have the Morningstar level of leader or advanced, and we compare that to those funds with a level of basic or low. And what we find is that there's only 2 US companies that earn this highest Morningstar level, and both of them we defined as a committed ESG fund. In contrast, there are 12 US fund companies that are rated basic or low, and 10 of the 12 are classified as other ESG fund. So in other words, our rating correlates very strongly with these Morningstar ratings, which gives you hopefully some degree of confidence in our measure. Our second validation test is based on the idea that engagement requires time. So again, we're trying to separate funds with high incentives to engage versus low. Our committed funds, those with high incentives to engage, if these funds are truly engaging, if they're truly seeking to increase the value of the firm through engagement, then these funds should tend to hold their portfolio firms longer. In other words, committed funds should be less sensitive to poor recent performance in portfolio firms. And so to test this idea, we're going to estimate a series of regressions. We're going to regress the net trade of each fund in each firm on an indicator variable for whether this firm had poor firm performance in the most recent quarter, where we'll define poor recent performance in column 1 based on unexpected earnings and column 2 based on lagged returns. And you can see that on average, funds tend to sell stocks with poor performance in the past quarter. However, when we also include this interaction term, committed ESG fund times poor firm performance, what that variable is capturing is the extent to which committed ESG funds behave differently than other funds. And the positive coefficient on this variable indicates that committed funds are significantly less likely than other ESG funds to sell following poor firm performance. In other words, they are, consistent with predictions, pursuing a longer-term investment strategy, which is exactly what you'd expect if the fund is relying on engagement. So in sum, both our validation measures hopefully give you some degree of confidence that we're truly capturing a difference when we look at committed ESG funds versus other ESG funds. So we're now going to go on to our main empirical tests. Just to remind you, our overarching prediction is that if fund managers perceive ESG to be a value driver, then committed ESG funds' higher incentives to engage should cause them to behave differently than other ESG funds on each one of these dimensions. So I'm going to start with information acquisition, and then I'll go on from there. Okay, so our first test, information acquisition. Our prediction is that committed funds' higher incentives to engage should cause them to do more research. If committed funds view ESG as a value driver, then this research should include ESG issues. So to examine this, we're going to examine mutual fund views of firm filings around ESG incidents. So within the US, the SEC has a database where you can find all firm filings. And over about a 10-year period, you can observe not only the firm filings, but you can observe who views these filings at a given point in time. So in other words, I can observe if Fidelity viewed General Motors 10K on January 31st, 2016. Okay, so that's the data that I'm using here. And so what we do is we look at firms that have negative ESG events, and that negative ESG event occurs at time 0. And then I'm looking at the extent to which committed fund families, those are the ones denoted with the orange line, view firm filings around these negative ESG events, compared to the propensity of other ESG fund families to view these same firm filings. And what you see is that around severe ESG events, committed fund families are much more likely to look at these firm filings compared to other firm families. In other words, committed fund families are doing more research. In contrast, if we look around inconsequential ESG events, we don't see much of a difference at all. Now, note this is all ESG events, and this is something that kind of always perplexes me. Why are E, S, and G all in one category? Because E, S, and G are not all the same thing, right? So what's really driving this? Is it E and S, or is it G? Funds are commonly marketed as ESG, but these really are quite different. And what are the real differences? Well, E and S issues are much costlier to evaluate compared to G issues. There's less standardized disclosure. There's less understanding on how these issues affect firm value. And those points suggest that the differences between committed and other ESG funds should be stronger with E and S issues compared to G issues. And that's exactly what we find. So among E and S issues, we see a lot more research by committed fund families, the orange line, compared to other fund families. In contrast, around G issues, things are about the same. Okay. So conclusion so far, committed fund families, they do more research around ESG events. Let's go on to test number 2, the investment strategy. Here, our prediction is that committed ESG funds are going to be less likely to sell after ESG incidents. Why? Remember, committed ESG funds represent the funds with high incentives to engage. If engagement can truly lead to ESG improvements, and if ESG improvements represent a value driver, then committed ESG funds would be more likely to hold on to these firms and engage with them, and thus less likely to sell. So again, we're going to do a regression analysis to examine this. We will regress the net trade of each fund in each firm in each quarter on indicator variables for whether this firm had a severe ESG event at that point in time. And our prediction is that among other ESG funds, this coefficient will be negative. In other words, other ESG funds will be more likely to sell the firm if the firm just experienced a negative ESG event. In contrast, committed ESG funds, we predict that coefficient would be closer to 0. That is, these committed ESG funds will be more likely to engage and therefore less likely to sell. This is exactly what we show. So we find that the net trades of other ESG funds are significantly negatively related to the presence of bad ESG news. In other words, other ESG funds sell following negative ESG events. In contrast, committed ESG funds do not sell. The tendency of committed ESG funds to hold on to these firms, again, is consistent with their high incentives to engage. They have a long-term investment strategy, and that strategy extends to ESG issues. Now, following what we just talked about, ES and G, is it really, what is really driving this? Is it the E and S issues that tend to be more unique, less certainty, or is it the G issues? We predict it's more E and S issues that differentiate these two sets of funds, and that's exactly what we find. So the takeaway from this set of regressions is that other ESG funds sell following negative ESG events. In particular, they sell following negative ES issue events. Committed funds do not sell after negative ESG events, including negative ES events. So in some committed funds, longer-term investment strategy extends to ESG issues overall, and in particular to ES issues. Okay, so to sum quickly, results to this point, committed ESG funds engage in significantly more information acquisition compared to other ESG funds, and they have significantly longer investment strategies. These findings are consistent with committed ESG funds engaging more, but now we want to look directly at engagement. So we're going to look at two measures of mutual funds engagement: conference call participation and shareholder voting. So our prediction, again, is that committed funds are more likely to engage with firms. Our first analysis, we're going to look at their participation in the Q&A section of conference calls. These are just sort of the details about how we identify questions pertaining to E&S issues on conference calls. We'll classify, we're going to focus on questions asked during these conference calls by buy-side analysts. So for each buy-side analyst, we'll identify whether that analyst belongs to a committed ESG fund family or an other ESG fund family. And we predict that committed ESG fund analysts are more likely to ask E&S questions. That is exactly what we find. So these positive coefficients in this regression here indicate that committed fund analysts are significantly more likely to ask questions about environmental and social issues in these conference calls. As an additional measure of engagement, we look at the voting behavior of these different types of ESG funds. there's a sort of large, literature, a lot of evidence that we have across both academics and industry on how mutual funds vote within the US in particular. And one of the key features of voting is that mutual funds can basically employ one of two different approaches. Their first approach is they can just follow the recommendations of one of these proxy advisory service companies, of which ISS is the largest. The second approach is they can more independently vote. That is, they can research the issues up for vote themselves in each portfolio company and decide themselves what is the more value maximizing way to vote. The sort of second kind of difference or dimension of voting we're going to look at is whether funds employ what's called a one-size-fits-all strategy towards voting. So a more low-cost way to fulfill your fiduciary obligation to vote is just whenever a certain types of proposal comes up, you can just always vote for that proposal or always vote against that proposal. For example, if there's a proposal to disclose Scope 3 emissions, you might decide you are always going to vote for or you're always going to vote against. In contrast, a more independent, intensive approach toward voting would be to say, oh, well, within this firm, disclosing Scope 3 emissions would be positive, whereas within that fund, it would be negative. So just to give you kind of a snapshot, here are a few different shareholder proposals related to ES issues on some different firms within 2021. So for example, Amazon had a shareholder proposal. The proposal was to oversee and report on a civil rights, equity, diversity, and inclusion audit. ISS recommended for this. In contrast, Bank of America had a proposal to request a racial equity audit, and ISS recommended against on that. Our prediction is that committed funds are going to be more likely to research each one of these types of proposals and evaluate themselves whether it would be a positive or a negative for the specific firm. In other words, they would be less likely to simply follow ISS recommendations all the time. So again, committed funds, higher incentives to engage should result in more engagement that is less simply following ISS recommendations. So here again, we're conducting a series of regressions, and consistent with predictions, we find that on both environmental and social proposals and governance proposals, committed funds are significantly more likely to come to a different conclusion than ISS. They are significantly more likely to be independently researching these issues themselves. We also look at this additional test of funds voting. Do funds simply follow a one-size-fits-all strategy? In other words, always supporting some agenda items, always rejecting others? Or are funds considering the firm's specific issues for each agenda item? Our prediction, again, if committed funds are engaging more, they should be less likely to employ a one-size-fits-all strategy. That's the regression specification we use for that. And that is exactly what we find. Committed ESG funds, they devote more resources to voting. They are less likely to follow one-size-fits-all strategy, and the magnitude is particularly large for ES issues. Now, one question you might ask is, okay, fine, you find that committed funds differ in their voting strategies, but are they actually voting in a, kind of a shareholder value way? And so what we evaluate are the shareholder value implications of these different voting strategies. And the premise here is that independent research and voting should be based on the value implications of firms' ESG policies. The implication is that there should be more negative abnormal returns when committed funds' votes do not equal the vote outcome. Put differently, if committed funds' voting strategies are in the best interests of firm value, then when the actual vote outcome differs, so when the actual vote outcome is different from what the committed funds preferred, we should observe more negative shareholder returns. And that's exactly what this graph shows. The red bars show the abnormal returns in cases where the committed funds votes differed from the vote outcome. And you can see that they are a little over 1% negative. Okay, so I've told you their information acquisition is different, their investment strategies are different, their engagement strategies are different. Committed funds versus ESG funds, they differ on many different dimensions. Why does this matter? Do these committed funds have greater impact? Do they affect portfolio firms' environmental policies? We're going to use two different measures of impact regarding environmental policies. The first is simply the overall risk index, which captures a broad measure of firms' ESG-related risks. And second, we'll use a more micro level, but arguably more precise measure, and that's simply firm emissions. Econometrically, we're going to use a lot of different approaches here. Some of this gets into the weeds of sort of showing our funds' behavior simply correlated with what we observe firms doing, or are these funds' actions actually causing differences in the firm? And I'm going to sort of give you kind of a broad overview in each one of these. There's more detail in the slides. I'm not going to go into sort of all the weeds here, and obviously a lot more detail in the paper. Our first approach is we're just going to estimate an OLS regression. We predict that committed funds will have greater impact on their portfolio firms due to their greater information acquisition, their longer-term investment policies, and their engagement. The setup is we're going to look at cases where a firm had a negative ESG incident at time 0. We're then going to classify how ESG funds behaved vis-a-vis this firm at that point in time. In other words, did ESG funds buy a lot of shares of these firms, or did they on net sell a lot of shares in these firms? And then we're going to relate this buying and selling to how firm risk changed over the subsequent 4 quarters. And that's the exact regression we'll estimate. Just focus on these negative coefficients here. So the first column is showing the extent to which firm risk decreases 1 quarter after that negative ESG incident. So we're looking at the change in firm risk here at quarter 1 in cases where ESG funds bought a lot of the firms. So if committed funds bought a lot, we see firm risk in the subsequent quarter go down significantly. And that continues to be the case over quarters 2 and 3 as well. Now, let's push that one step further. So this just says that in any case, on average, where committed ESG funds buy, we tend to see firm risk decrease in the subsequent quarters. You might ask, okay, but committed funds, they're engaging more with some of their firms than others. So we're going to look at the extent to which this relation between committed funds buying and subsequent changes in firm risk, we predict that that negative relation will be strongest within the portfolio firms that these committed ESG funds engage the most on. And so that's what we're going to do here. This coefficient here captures the extent to which that negative relation between committed ESG funds buying and subsequent firm risk, we find that that negative relation is concentrated within firms where they engaged the most with. Okay, so a question that we always struggle with in academics and in practice is funds performance just correlated with firm behavior, or did funds' actions actually change firm behavior? And so here we do something that we call a diff and diff analysis to try to isolate causality. So we're going to focus on cases where firms where there's high ownership by committed funds. The premise is that if funds have high ownership, then they have higher net benefits of engagement. And we will look at how the firms, these firms that are highly owned by these funds, how their behavior changes following an exogenous increase in these mutual funds investment. And that exogenous increase, that shock to flows, we're going to measure with the introduction of the Morningstar sustainability ratings, which occurred in 2016. The introduction of those ratings caused a large increase into the flows of high ESG funds. And what we find, and again, this is sort of the econometrics in the weeds here, but the basic takeaway is that following a firm ESG incident, firms with the greatest investment by committed funds experienced decreases in ESG risks. What this approach does is this shows that its funds' actions are actually causing these changes in firm risks. It's not the case that funds are just buying firms that were working on their own to decrease risks, even in the absence of any fund action. As our final analysis on impact, we're going to look at the extent to which these increases, these decreases in firm risk and these decreases in emissions are concentrated among firms where committed funds engage the most. We'll measure that in terms of their voting behavior. And in cases where committed funds have the highest incentives to engage, we'll measure that as the fund family being one of the firm's largest investors. And what we find in both cases is strong support. So in other words, this sort of relation between committed funds having high ownership in a firm and the subsequent decreases in firm risk, those are concentrated among cases where the fund engages highly with the firm, for example, in terms of their voting behavior, and in terms of when one of these funds is among the top investors, that they're one of the mutual fund families with the largest ownership in the firm. Okay, so what do we have? Results to this point suggest that committed funds view ESG as a value driver. They prioritize information acquisition on ESG. They have a long-term investment strategy with respect to negative ESG events, and they engage on ESG issues. All of those together contribute to a positive impact on firms' ESG profiles, and across many tests, that's exactly what we find. In the last part, we want to come back and we want to ask, are committed funds correct in viewing ESG as a value driver? If they were correct in this viewpoint, then they should earn higher returns as a result of these activities. And so what we're using is sort of this measure, DGTW, characteristic adjusted abnormal returns, just a measure of abnormal performance. And we're going to compare the performance of committed ESG funds to other ESG funds. And what we find is that committed ESG funds have outperformed other ESG funds pretty much on exactly those cases where you would expect them to. They've outperformed in cases where they've held the stock for longer, in other words, where engagement should be more effective. And they've outperformed on ESG stocks, and that's exactly where their expertise lies. Are committed funds rewarded with greater flows? We find no evidence that they earn greater flows after controlling for performance. So let me conclude. I know sort of a lot of findings here. Let me kind of provide an overall summary. Our research question is, do ESG funds actually affect firm policies? And our hypothesis is that it depends on funds' incentives to engage, as well as whether these funds truly believe that ESG is a value driver. Committed funds represent those funds with higher incentives to engage on ESG firms. And we find strong evidence that committed funds have different investment strategies. They're more likely to research the firm around negative ESG events. They're less likely to just indiscriminately sell around these events. Committed funds also engage with firms on ESG issues in terms of voting and in participation in conference calls. These committed funds, they influence firms' ESG policies, which follows naturally from our evidence regarding their investment and engagement strategies. We find that an exogenous increase in committed funds holdings contributes to ES improvements. And finally, these findings, they're not just sort of good ES policies, they're also good for shareholder value or the investor value. Committed funds earn higher returns on their ESG portfolio investments compared to other ESG funds. So I'm going to stop there. Thank you very much for your attention.
Thank you very much, Michelle. Very, very clear presentation. Excellent. Questions from the audience? Marie, Sophia?
Yes, I'm happy to ask a few questions. So thanks a lot, Michelle. A great presentation, as Jocelyn said, very, very clear. So I enjoyed it a lot. So my first question is about the definition of what is a committed fund. So it looks to me that these funds are long-term investors, right? They invest in less liquid stocks. They have less turnover. I was not entirely clear with the definition of fluid. So maybe you can elaborate a little bit more on that. But if that's the case, because you have the two definitions and you say that they both converge, I was wondering, did you check if because you showed they're less likely to sell when there is an ESG event, bad news on ESG, but did you also check, I was not sure to see that in the regressions, if they are less likely to sell than for other types of news? Because you might think that if these are long-term investors holding less liquid stocks, they might be less likely to sell for any kind of bad news, being ESG or being an ES or a financial news. So we would like to see if there is something additional on ESG news. Another question is about the vote. I mean, your results about the discrepancy with ISS are quite interesting. Did you also check when depending on the direction of the discrepancy, so when they disagree with ISS but being pro-shareholders, so meaning that they would like to implement more prescriptive environmental and social policy, or is it more when they are pro-management? Because there are two different ways to vote differently from ISS. And yes, my last question is also related to the liquidity exposure of these funds. When you show that they outperform, that the committed firms outperform the other firms, did you check if that remains true if you control for the liquidity exposure? Because you might think again that they are investing in less liquid stocks, and that might also explain that they earn a liquidity premium for that, and that they outperform the uncommitted funds for that reason. So these are my
great questions. Okay, thank you very much. So let me start with the definition of committed funds, because clearly sort of the understanding of all the other issues does hinge on that. So our main results are reported based on this Llewellyn and Llewellyn measure, and it's based on two fundamental components. One is the direct component. That's a function of the dollar value of a fund's holding in a given firm. And the idea is that if a fund holds a larger position in a firm, then that fund is going to benefit more from an increase in that firm's value. And so therefore that contributes to higher incentives to engage. So that's the first component.
So it's a bit of measure of concentration, right?
Well, that's the way we should understand.
Yeah, the first one.
That's the first, and
Yeah,
they definitely, without question, so just give me 2 seconds. So without question, the committed funds do have more concentrated holdings, but then there's also this indirect component, and that plays an important role too. And what that captures is the holdings of this fund in the firm compared to the holdings of all other funds in the firm. Because the idea is if I hold more than everybody else, then my fund is going to go up more than everybody else, and so I'm going to earn more flows. Sorry, I didn't mean to cut you off. I just wanted to complete
No. Thanks for clarifying. So that's a matter of how much skin in the game you have compared to other mutual funds. That's the way we should understand it. So there is nothing related to ESG here. It's a measure of commitment towards companies. Could be because you have financial incentives to do so. But it happens that they're also more proactive on environmental and social issues. That's the way we should understand your results.
Yes, exactly. And that feeds directly into your second question. So the way we think about it is if you have higher incentives to engage, there's no question that you're going to engage on things that we know have financial ramifications, things like earnings, right? I mean, it's a given. The question is whether they're also going to engage more on ESG issues, because they're only going to do that if they believe and perceive these to be a value driver. And what everything shows is their behavior indicates they do believe it's a value driver, and the evidence on return suggests that they were correct in believing that.
Thank you very much.
Yes. Yeah. And then the only other thing I'd highlight there is remember, or I shouldn't say remember, but like in our definition of ESG funds, only about 40% of an ESG fund's holding is in ESG stocks. So they have a lot of, choice over what they're investing in there. Your other 2 questions, in terms of votes, yes, I just showed you the results where we have disagreement with ISS as the dependent variable. We have also done subsample analyses. I can talk to you more offline, but the basic takeaway is we do a lot of additional specifications to ensure that we're not just finding a more pro-management bias, and that is not the case. And then the final thing on liquidity, yes, we do control for liquidity different ways. We've actually done those results using different measures of abnormal returns and controlling for extra independent variables to capture those types of effects. But thank you very much for the questions.
Thank you. Great presentation.
Thank you, Michelle. I think there's a question from the audience. Dimitrios Golopoulos.
Yeah, thank you very much. Dimitrios Golopoulos from the University of Malta. Michelle, thank you very much for your very interesting presentation, as always, I will add. Some further questions as a backup of the ones that has been made before. What percentage of the funds are considered to be committed, number one? And if you have thought to even spread out more this definition because now it's a binary 1-0, I mean, those among the committed funds that they are even more into it. For example, if there is any way to provide even deeper information, if I am allowed to say.
Yeah, that is an interesting question. Okay, so in terms of the percentages, about 1/3 of all mutual funds are ESG funds, and then we split ESG funds equally between committed and non-committed. So it's just above median versus below median measure. In terms of the degree of commitment, yeah, that's a great question. Let me give you a 2-part answer. We have not just used a continuous measure, and we could. Part of the reason we don't do that is because we want to make sure that we control for the amount of holdings in ESG stocks. So we want to make sure that we're not conflating sort of commitment to ESG with amount of holdings in ESG. And that was kind of the reason for our setup, but we could think more about that. So that's my first part of my answer. The second part of my answer is we do a fair amount of heterogeneity among committed funds in different ways. And I only showed you those results for the second part when we're looking at impact. But for example, when we look at among committed funds, does a committed fund engage more with this firm compared to that firm? And we show that impact is greater among the subset where the fund engages more. And then also we look at among committed funds, comparing those that are one of the top shareholders in the company suggesting a bigger impact with, a smaller shareholder. So that's the kind of thing we have differentiated on, but we could think more maybe about doing a more continuous measure. So thank you.
Thank you very much, Michelle.
Yep,
Thank you very
absolutely.
much. Unless there's another question.
Maybe
Yes,
can
Stefano, of course,
Thank
you're
you,
allowed to.
A very interesting paper and presentation. I was just thinking about your second definition of commitment, the one relying on the pastor et al. Basically, that under diversified funds should be more committed because for them it's more costly to divest from the firms, if I understood correctly. So it would be maybe nice to also look at variation across firms in how much their stocks correlate with the fund portfolios. So I said in another way, if a firm's stocks is less positively correlated with the fund portfolio, then it's more precious for fund managers, okay? Because it's more precious for diversification purposes. So the fund manager should be more reluctant to divest from a company that correlates less with his portfolio. Maybe.
Yeah, so I think it captures that somewhat in the, but maybe not as directly as you would like. So we do, the measure is based on both the liquidity of each individual stock as well as the portfolio diversification. So that portfolio diversification is capturing part of what you're saying, but I guess what you're saying is maybe to go one step further.
Exactly,
and
at the firm level.
Okay, yeah, that's a great idea. We've never heard that before, so we could definitely take a look at that. Thank you.
Super.
Okay, well, thank you very much. Well, Stefano, you have the floor now.
That's super. So let me share my screen. Okay, I hope you can all see it. That's perfect. So first of all, thank you very much to the ESSEC-Amundi chair for the invitation. It's really a pleasure to be here and have the opportunity to present my research. And also thanks for including my paper in this very interesting session with Michelle's paper. So my paper, the paper I'm going to present is titled Reveal Belief About Responsible Investing, Evidence from Mutual Fund Managers. It's a joint work with Alex Wagner, the University of Zurich, and Vitaly Orlov in St. Gallen with me. And this is still a work in progress, so any comments you may have will be highly appreciated and helpful to revise the paper. So what's the big question of our paper? As you may imagine is, do environmental, social, and governance strategies improve financial performance and firm value? So the same big question that also Michelle asked with her papers. And we have relative large research on the behavior of investors. In particular, we know that retail investors value sustainability, potentially also for non-pecuniary motives. We also have some studies focusing on employees. For instance, a recent working paper by Kruger et al. Showing that workers have preferences for sustainability of their employers and are willing to accept lower wages to work for a more environmentally sustainable firms. And we also have research on customers. And we know that customers like more sustainable firms. So the question we ask in this paper is, what do professional investors believe regarding environmental, social, and governance factors? So do they relate to higher expected financial performance or lower expected financial performance? Okay, we think this is an important question to ask because professional money managers are likely to be the so-called marginal investors in financial market, setting prices. And we have two different narratives about what fund managers really believe about ESG strategies, okay? And what I mean with ESG strategies is not really about engagement, okay? This the aspect that we just saw in the other paper, but we mean selecting stocks based on ESG performance, based on their ESG profiles, okay? And here we have two opposing narratives. On the one hand, we have a narrative that sees ESG investment strategies as an enhanced form of portfolio management, okay? So this means that we can increase the financial performance of our portfolio by tilting it towards higher ESG stocks. Okay? And we have some papers supporting these narratives that fund managers can improve the financial performance of their portfolio by also including ESG information, okay? ESG skills. On the other hand, we have another narratives out there that see ESG just as a strategy to maximize flows, fund flows, hence maximize fees at the expense of financial performance. So in here, we have a clear trade-off between portfolio sustainability and portfolio financial performance, and a sort of a deviation from the traditional goal of fund managers to maximize risk-adjusted return. Okay? Instead of maximizing risk-adjusted return, perhaps fund managers try to maximize their fees, okay, their investment flows, enhance their fees. So how can we disentangle these two narratives? How can we test which one better reflects what fund manager believes, what fund manager thinks? So in finance, in economics, we have two traditional approaches to uncover investor beliefs, okay? Because beliefs are unobservable to us as scholars. So we need some way to uncover them. So our first approach is the classical asset pricing approach, consists of looking at realized return and treating realized returns as a proxy for what people expected ex ante. Okay, so this approach works well when we have very long time series, but for new trends, we know that realized return may not necessarily be indicative of what people expected ex ante. Okay, so saying that, for instance, ESG firms perform poorly, okay, or better than other firms during the last few years is not really indicative, does not tell us much about what investors, marginal investors particularly, expected ex ante. So this approach is not particularly well suited for answering our question. The second possible approach is through surveys. Okay? Surveys are great, very helpful in studying emerging topics. So for instance, we have started surveys about what institutional investors think about climate risk, or in general about ESG strategies. So Giglio et al., very interesting paper. They look at what retail investors think about ESG strategies, and so on and so forth. Also allowed to put a paper, recent paper I have here with my co-author Marco Ceccarelli about retail investors and how they perceive the climate transition. However, surveys with fund managers have also drawbacks, and the drawbacks is that fund managers are likely to express excess optimism about the financial performance of what they're doing. Okay, also because they need to justify their investment strategy. So it's very unlikely that fund manager will admit that they will do ESG, they adopt ESG selection strategies just to maximize their fees. So that's it's a problem that we have. So what's our approach? Our approach is a so-called reveal belief approach, exploiting or leveraging on the powers of incentives. Okay, so we know that managerial ownership is an effective tool to mitigate agency problems in finance in general, and we also link to the existing literature showing that fund managers, money managers with skin in the game, so with higher ownership in the fund they manage, okay, that's what we mean with skin in the game, are less likely to hold, for instance, lottery-like stocks that are very good to attract flows, but not very good to maximize long-term financial performance. Managers with skin in the game, they are less likely to take excessive risk, okay, to exploit the well-known non-linear relationship between performance and fund flows. And in general, they are likely to deliver higher risk-adjusted performance. So we know from the existing literature that when a manager has skin in the game, okay, so stronger incentives to perform well, this manager will tend to move their portfolio so that to maximize return. Okay, so here, as I wrote here, managers with skin in the game are more likely to invest based on what they believe to be good for financial performance. Okay, so our question is, do fund managers invest more or less in high ESG stocks when they have stronger financial incentives to maximize the portfolio financial performance? Okay, so when they have skin in the game. So this is what we ask in this paper. And here we have different predictions. So according to the narrative that fund managers select firms on their ESG profile to maximize return, we would expect a positive relationship between the managerial skin in the game and portfolio sustainability. Okay, so that means that if a manager has more money, personal money invested in the fund he or she manages, then the fund manager should tilt the portfolio towards higher ESG stocks. Whereas, accordingly to the narrative of doing ESG just to attract flows, we should observe a negative relationship between managerial skin in the game and portfolio sustainability. Okay. So let me tell you straight away what are our main results. So our main finding is that on average, managerial skin in the game is associated with a lower portfolio ESG performance, lower portfolio ESG scores. And in particular, this negative effect of managerial ownership on ESG is more pronounced when fund managers are paid based on asset under management fees, rather than when they are remunerated based on financial performance. We also look at what happened after changing in skin in the game in ownership. And we show that within funds, when managerial ownership increases, then future portfolio sustainability performance decreases. Okay, while we do not see any evidence of the opposite direction. We then also look at exogenous shocks. Exogenous shocks in terms of the incentives to buy, to tilt the portfolios in a high ESG directions. Then we show that funds with managerial ownership are less likely to move towards high ESG stocks following this exogenous shock in ESG demands. Okay, I'll tell you in a few slides what we mean with that. So overall, our interpretation is that fund managers, on average, so I want to emphasize this, on average, do not consider ESG selection as an innate form of portfolio management to maximize risk-adjusted return. Okay, so now I will tell you a little bit more in details how we arrive at these results. So data. So we start from universe of all US equity open-end mutual funds in the Morningstar universe. Okay, we merged the data with CRISP, arriving at around 4,500 equity funds, and we decided to focus exclusively in the main analysis on active conventional, okay, so broadly diversified US equity mutual funds. So here we are not talking about explicit sustainability funds, ESG funds. So we excluded from the main sample funds that commit in the prospectus to pursue ESG investment strategies. Okay, and we did that because the fund managers of these funds do not have discretion in tilting their portfolio more or less towards high ESG stocks. So our exercise for these funds is not particularly helpful. Okay, but we will use later in my presentation explicit ESG funds for a placebo test. Okay, so starting from this universe, we hand-collected information on their ownership of their fund managers. Okay, so where we got this information from, this so-called statement of additional information from the SEC Edgar database, which is a report that fund managers, mutual funds in the US, they have to file every quarter to the SEC, okay, stating the ownership of fund managers in the fund. And our sample period goes from January 2015 through March 2021, and we end up with managerial ownership of around 1,500 individuals managing 1,200 funds. Okay, so before moving forward, let me provide you an example of how a typical statement of additional information look like. So here we have the statement of additional information of this fund named Invesco Small Cap Growth. So here we have information on the fund managers and their ownership level in brackets. So the personal money they invested in these funds that they are managing. So we don't have the exact number of the ownership, but we have information of whether the ownership fall in one of these brackets. So we have 7 brackets. Okay, and we take the mid-level as the ownership amount for each fund. And we defined a set of variable of interest. So we have the variable ownership. This is just a dummy variable, an indicator equal to 1 if managerial ownership in the fund is above 0. Then we have the log of 1 plus ownership, which is just the log of 1 plus the total amount of personal money of fund managers invested in the fund. Okay, and we also compute other alternative measures. So in particular, we look at the percentage of ownership over asset under management, or the average ownership of fund managers in case the fund is managed by a team and not just by one individual. Next, we retrieve portfolio sustainability data. And for our main analysis, we take just the portfolio sustainability scores from Morningstar that, as you may know, are based on firm level data from Sustainalytics. Okay, so we have data also based on ESG firm level ESG data from other providers like MSCI, and the results are similar. And we defined as our main dependent variable the variable peer adjusted sustainability score. So very, very simply, we take the ESG score of the fund and we normalize it by the average ESG score in the same category. Okay, it's just to simplify the interpretation. Our results are similar when just looking at the raw sustainability score of funds. And we also look at Morningstar sustainability globes, so these ratings and other alternative version of ESG scores. Okay, so let me give you an overview of the sample composition. So here, this graph shows the mean ownership, the mean skin in the game in US dollar, so reported on the left vertical axis, and the fraction of managerial owned funds. So we observe that 77% of the funds in our sample have at least some type of skin in the game. So at least one manager's co-investing in the fund. And the average managerial investment is around $800,000 US dollars. So these numbers may seem pretty high, especially the average managerial investment in the funds, but they are in line with the existing literature using similar data. So for instance, here I compare our data to the statistics reported by Mein Tang, so a management science paper from 2019, whose sample periods end at the end of 2014, so right before the start of our sample period. And as you can see, these two graphs are very similar. So at the end of their sample periods, the average managerial ownership in US mutual funds was around 700,000 US dollars. In our case, it's a bit higher. Okay, so these graphs already give you a glimpse of the results because shows the sustainability performance, so the average ESG scores for funds, mutual funds with managerial ownership, skin in the game, the blue bars, and for funds without managerial ownership, okay, without skin in the game. And as you can see, the sustainability score of funds with a skin in the game managers is systematically lower than the ESG scores, sustainability performance, of funds managed by managers without skin in the game. This second graph just shows the distributions of mutual funds, okay, based on their sustainability globes ratings from 1 to 5, dividing the sample in funds with skin in the game or without skin in the game. As you can see, funds with skin in the game managers have on average lower sustainability ratings. Again, on average, because we observe quite a substantial degree of heterogeneity. So we also see the managerially owned funds with the top ratings in terms of sustainability performance. Okay, so there is a lot of heterogeneity. Okay, now we formally test our the role of managerial ownership in formal regressions analysis. So what do we have here? So here on the left-hand side, we have the sustainability scores in quarter T+1, okay, so future sustainability scores of the funds. And on the right-hand side, we have ownership, so this dummy variable, this indicator equal to 1 if the funds is managerially owned and 0 otherwise, and other mutual fund characteristics such as size, the expense ratio, turnover, flows, return, volatility, and so on and so forth. In column 2, we also add information about the remuneration structures, okay, of the managing team. And in the second part of this table, from column 4 to 6, instead of using this dummy variable ownership, we look at the amount invested in the funds, okay, by their fund managers. Okay, this log 1 plus ownership. So, and what we see is that managerial co-ownership is associated with lower future ESG performance. Okay, and the effect is quite important economically, okay, not just statistically from a statistical point of view. In fact, this ownership indicator explains almost 50% of a standard deviation in the sustainability, in the variation of sustainability score. Okay, so it seems to be quite important. And these results, this negative relationship between ownership and sustainability performance holds with many different specifications. Okay, so controlling for fund fixed effect, fund family fixed effect, managers, team fixed effect, and so on and so forth. And the results also hold using the continuous measures of ownership. So we see that the higher is the amount co-invested, the higher is the reduction in a fund's ESG performance. Okay, and also here, the result is not only statistically significant, but also economically important. Okay, so this is just a visual representation of these results in a Binet scatter plot. So you can see there is a negative relationship between ownership and sustainability performance. Okay, this seems to be consistent with the interpretation that mutual funds, they tilt their portfolio towards higher ESG stocks as a way to maximize flows rather than as a way to maximize financial performance. Okay, so our interpretation, our whole exercise is based on the role of managerial incentives. So we increase the incentives to fund managers to perform well, and we try to observe how they react in terms of ESG fields. Okay, and so we look at one particular type of managerial incentives, that is wealth incentives. So how much money they have invested in their funds. But obviously, there are other types of financial incentives that may incentivize fund managers to move the portfolio in a certain direction or another direction. And in particular, managerial incentives are significantly shaped by their compensation structures. So how their remuneration is structured, okay, how on which stance they are paid. So to control also for these second dimensions of incentives, we collect additional data still from the statement of additional information, and we build additional variables of interest. So here we have a dummy equal to 1 if the fund manager is paid just with a fixed salary. So this is just for a small minority of our sample, so just 4% of our observation have a fixed paid remuneration structures. Then we construct this indicator equal to 1 if the managers of a specific fund is paid based on fees on asset under management. So this is equal to 1 for around 1/4 of our observations. And then we also construct this indicator performance pay only, that is equal to 1 if managers are paid exclusively based on financial returns. And this is equal to 1 for around 1/3 of observations. Okay, so once we collected this data, we wanted to understand how the skin in the game, so the managerial ownership, interact with the remuneration structures in influencing the fund's ESG performance. So let me start here by commenting the direct effect of having a remuneration based only on financial performance. So here we observe that if a manager is paid only based on financial performance, the funds will tend to have a lower sustainability score. Okay. Whereas if the fund manager is paid based on fees, based on asset under management, this is correlated with a higher sustainability performance. Okay. Next, we look at how the remuneration structure interact with ownership. So, and we see that when pay is exclusively performance-based, then ownership does not further move portfolio away from ESG stocks. This is indicative that if a manager is anyway paid to maximize financial performance, then having or not skin in the game in the fund, okay, through co-ownership, ownership of the fund, does not influence the fund's ESG score. And when managers when managers are paid on based on asset under management, then we see that having skin in the game has a negative effect. So basically neutralize the effect of asset under management pay on sustainability performance. Okay, so if a manager is paid to maximize asset under management, this manager will tend to tilt the portfolio to high ESG stocks, but not when this manager has skin in the game. So personal money invested in the fund. Okay, next, so far we look at just the effect of ownership on ESG performance. As a next step, we analyze the effect of ownership changes. So, okay, the ownership skin in the game measure is relatively sticky over time. So managers tend to keep their investments in their fund or not having investment in the funds, but we observe some changes in managerial ownership, skin in the game. In fact, we have around 1,000 fund quarter observation with changes in managerial ownerships. The majority are increases in managerial ownership, but we also have quite a few of decreases in ownerships. And what we observe is that increases in managerial ownerships are followed by a decrease in ESG performance and vice versa. So when ownerships decreases, we observe the ESG performance to increase in the next quarter. And interestingly, we do not see any clear evidence of the opposite directional effect. So we don't see that changes in fund sustainability score, ESG scores, are followed by changes in ownership. Okay, so it seems that it's ownership that is driving ESG performance and not the other way around, and not ESG performance that is driving ownership decisions. Okay, talking about controversies, so far we look at ESG scores. As a related exercise, we also look at the exposure of portfolio firms, constituents, to ESG controversies. Okay, as an alternative measure of ESG performance. And what we observe, so these different measures, severe, high, significant, moderate, low, are the asset-weighted exposure of portfolio firms to severe controversies, high controversies, and so on and so forth, as defined by Sustainalytics and Morningstar. And what we observe is that managers with higher skin in the game, with higher managerial ownership, have a higher exposure to firms with severe controversies and less exposure to firms with low or no controversies at all. Okay, so this result is consistent with our main results on ESG scores. Okay, so far we documented a negative relationship between skin in the game and portfolio sustainability. Our interpretation is that on average, US fund managers do not consider ESG selection as a positive driver of portfolio sustainability performance. But of course, there are also other potential interpretations. Okay, an interpretation that we find particularly interesting is the so-called signaling explanation. So it's possible that if a fund is low sustainability, so has a low ESG scores, then the managers requires some signals, okay, to reassure investors. And one signals may be putting personal money in the fund. Okay, so this interpretation is also possible and worth investigating. So to further test our incentives, reveal belief interpretation, we perform other tests. Okay. Ideally, here we would like to have an exogenous shock in funds managers' skin in the game ownership. So some changes that cause an exogenous variation in the financial incentives of fund managers to move more towards or away ESG stocks. Okay, unfortunately, we don't have this type of exogenous shock, but we have an equivalent type of exogenous variation in the incentives of fund managers to tilt their portfolios to high ESG stocks. Okay. One of such shocks is the publication of Morningstar Sustainability Globes. This is an exogenous shock that increases fund managers' flows incentives to buy high ESG firms. Okay, because after Morningstar published the Sustainability Globes, having a higher ESG scores started being rewarded more by investors with higher flows. Okay, so investors flocked to funds with higher sustainability ratings, and fund managers increased their demand for high ESG stocks for non-fundamental reasons. Okay, this is a paper, this is the result of this paper by Ganchev et al. So our expectation is that if our interpretation is correct, we should observe skin in the game managers to move less to high ESG stocks for non-fundamental reasons. And this is exactly what we observe. We observe that skin in the game managers move less to high ESG stocks after the publication of the Morningstar Sustainability Globes. Okay, so the results here are not quite statistically significant or very strong statistically significant, but they are economically important. So this interaction term, diff and diff effect, explain more than 70% of all one standard deviation in sustainability scores. Okay, next we look at another type of shocks in the flows incentives of having high ESG scores, and this shock is represented by COVID-19. Okay, and many papers claim that COVID-19 represented a positive shocks in the demand for sustainable investments. Okay, and some of these papers claim that this demand was non-fundamentally driven. Okay, not driven by firms' fundamentals. So it's interesting to see how skin in the game managers behave. And what we see is that co-investing managers during the COVID-19 outbreak, so in the first quarters of 2020, moved less towards high ESG stocks than managers without skin in the game. Okay, so apparently fund managers did not consider ESG factors as a major driver of firm value during this particular period. Finally, as a placebo test, we replicate all our analysis using alternative samples of fund managers with little discretion in their ESG exposure, ESG deals. And these subsamples are US mutual funds that are explicitly marketed as ESG, so ESG mandates funds, and managers that are passive, that are index funds. So by definition, they don't have any discretion moving the portfolio towards or away ESG stocks based on managerial ownership. And in fact, we observe no clear relationship between managerial ownership and sustainability for funds with explicit ESG mandates. So here, again, we look at whether they commit to follow ESG strategies in their prospectus. And also, we don't see any clear relationship between managerial ownership and sustainability for index funds. Okay, so again, the interpretation is that if a fund is passive, whether the fund manager has skin in the game or not, cannot influence their portfolio decisions. So I'm already at the conclusion. So how does ESG integration relate to financial performance? So it's a way to maximize financial returns, as many argue, or is it just a way to maximize flows? So our approach is, let's see what fund managers believe. Okay, do they tilt their portfolio in a ESG direction where they have personal money invested in the funds? And our finding is that on average, US fund managers do not seem to believe in sustainable investment strategies as a enhanced form of portfolio management. So they, based on our results, they seem to relate higher portfolio sustainability scores with a lower expected financial performance. We want to stress that, however, ESG strategy may or may not pay off in the long run, regardless of what fund managers believe. Okay, so we wanted to document what they believe, but we don't look at the future realized financial performance, and fund managers may have beliefs that are distorted or myopic. Okay, so ex ante is very hard to tell. So we are conducting other tests, our analysis, to revise our paper. And I just wanted to give you an overview of what we are doing. So an interesting analysis that we are eager to do is look at the role of political preferences. So perhaps, actually it's quite likely that Democrats have different beliefs than Republican-leaning fund managers. So we know from the literature that political preferences may have strong impact in beliefs, in vision of the future, vision of the worst. So we wanted to test that. Next, we are planning to replicate the analysis at the fund firm level, so looking at active position changes instead of just the average ESG score in the fund. And we are also splitting the sustainability scores in its individual dimensions to better understand which ESG aspects fund managers relates more to financial performance and which less. So this goes in the direction of trying to be more granular when we talk about ESG. So thank you very much again for the invitation, for your attention, and I'll be happy to answer questions.
Thank you very much, Stefano. Excellent presentation. Questions from the audience? Sophia?
Yeah, I have a question. So in your first table that you present, Stefano, so it might exist some problem of simultaneously, right? Or taking simultaneous decision, because I mean, there are many studies that show that ownership or skin in the game is also related with the risk that you take. And when you see here volatility, it's also quite statistically significant. So when the manager takes the decision to invest or not invest on stocks with more or better ESG scores, it also taking the decision of the risk that takes in the fund, right?
Yes.
So maybe to address this issue, and I don't know if some interaction to control for this relation that because both are related, right? When the risk, it also will affect the future performance of the fund.
No, that's true.
Yeah.
So of course, so here again, we are, while we're addressing the sustainability score in the following quarter on past funds performance. So we had to control for a return, volatility, and so on and so forth. But it's, of course, one can do more. Maybe to reassure you on this concern, these results also hold with fund fixed effect, which somehow controls with some characteristics of the fund that remain fixed over time. But you're right. There are many things that could go on here. But this negative relationship between ownership and sustainability is surprisingly robust. So it holds even without controlling for anything and also controlling for many things. So, but yes.
Michelle, you have a question?
Yeah, I actually had two questions. Super interesting paper. I know of it, but I haven't seen it presented. So thanks, and really clear presentation. So I had two questions. My first, I guess, is somewhat overlaps Sophia's. If I understood right from your univariates, the difference in the funds is really driven by the propensity to hold kind of these super bad environmental stocks, right? The ones with globes 1 or 2, and maybe especially 1. And it's not driven by the upper end of the distribution, right? The propensity to hold 5 is equivalent and 4 isn't much difference. And I was really intrigued by that because I think of these really kind of poor environmental citizens as being the riskier guys. But to Sophia's point, those are firms that these, kind of high ownership funds have in the past been less likely to hold. So maybe controlling for this even makes your results get stronger, but just sort of thinking about what's driving it and what you'd expect it to drive, sort of these really low versus really high, I think would be interesting to consider. So anyway, that's kind of my first sort of set of comments. And then my second, I guess just on the placebo test, your argument that ESG funds don't have flexibility is, maybe a little bit strong, at least in our sample, our definition of ESG funds. The average ownership in ESG stocks by these funds is less than 40%. I think it's 38%. There's heterogeneity around that, and that's true kind of however you define ESG funds. So I don't know what's driving that result to be so much different, but maybe just something for further thought. So
Thank you.
that's it, but really interesting paper. Lots to think about. Appreciate it.
Super. Thanks a lot, Michelle. I fully agree with you, especially on this, the second point. Yes, maybe I overemphasize this lack of discretion in stock selection among ESG funds. So we have another problem when using ESG funds in our exercise, in our setting, is that it's very likely that there is a self-selection of fund managers into these funds. So if you believe that ESG is good, you're more likely to be a manager, so self-select yourself in high ESG funds. So that could potentially also be a driver of this lack of negative relationship that we see here. Okay, so it can be a mix of the lack of discretion, but also the self-selection of fund managers into these funds. So that is a more heterogeneous belief interpretation. That is.
I wonder if you could take advantage of that. A lot of fund managers are managers of multiple funds. And so I don't know whether you might have some cases where a single manager is part of a team on both of an ESG fund and a non-ESG fund. But if that was the case, that might give you some interesting heterogeneity to explore.
Thank you. Thank you. That's I think we do already a test in this direction, but I don't remember the details, so I will postpone my comments on this great idea to later stages. And on the first point you raised, that's a great point. We still have to explore the non-linearity between ownership and skin in the game and ESG performance, if I may say so. It's a non-linearity, so it's true that managers with skin in the game may be more likely to invest in very bad ESG stocks. Why? Because maybe they perceive the stocks to be severely underpriced, for instance, right? That's potential interpretation.
Question from the audience, Aaron Wu?
Yeah, I have a question. Yeah, very, very nice presentation. I just want to ask about the flows with the fund manager's ownership, because sometimes the fund manager, fund companies just use the ownership as a marketing behavior to attract fund flows. So maybe the skin in the game is not about the sustainability; it's more about flows. Yeah, that's my question.
Yes, thank you. No, that's true. That's exactly the in line with the interpretation that we call signaling explanation. Okay, so signaling explanation is not exactly clear whether, so there are some papers on that. So the relationship between skin in the game, so managerial ownership and flows, is not very clear and established. So it's not necessarily true that managers with skin in the game attract higher flows.
Yeah,
okay? But of course, we are aware that this managerial ownership must be driven by something. So this is not an exogenous features. Okay, so having skin in the game is not an exogenous feature. So if managers have skin in the game, perhaps it's because they want to signal something to their investors. That's why we wanted to provide a more support to our interpretation with these exogenous shocks in the flows incentives of holding high ESG stocks, okay, without necessarily ruling out the signaling explanations. So that could still be there and coexist with our interpretation, of course.
Thank you, Stefano. You know, Marie is gone, but she left a question for you. So I'm going to read it. She says she's referring basically to Europe, because you're talking about U.S. mutual funds, and she's asking whether the results would hold also for Europe, and because the compensation structure is different in Europe, typically also depend on ESG performance, and also she says that beliefs can also be different in Europe. Bauer 2024 had a recent international survey of CFA holders showing that finance professionals have a very heterogeneous beliefs about ESG performance. So basically, she's wondering if your results would what's your view on whether this can hold for Europe?
Thank you. That's a great question. That's a great question. Of course, with this paper is very hard to replicate in Europe because we don't have information about skin in the game. So my gut reaction would be, okay, in Europe, people tend to believe more in ESG strategies as a way to attain higher financial performance. So my gut reaction would be, maybe in Europe, we will not observe a negative relationship, but maybe a neutral or even a positive one. But it's not as easy because if that would, so these preferences on these average different beliefs would also impact the prices of high ESG stocks. So that would also somehow bring the system back to, let's say, equilibrium, okay? Because fund managers, they may not necessarily want to hold high ESG stocks, but they may want to hold high ESG stocks that are currently underpriced by the market. Okay, so in a sense, it's more about the beliefs of whether the market is currently pricing ESG appropriately or not. Okay, so it's a matter of whether fund managers believe that the market is correctly pricing intangibles, if we may define ESG as intangibles, correctly or not. Okay, so maybe in Europe, people tend to like more ESG stocks, but if that translates in higher market prices, going forward, buying high ESG stocks may still lead to lower returns. So, but that's of course would be very interesting to compare the results with Europe. And I was not aware of this new paper by Rob Bauer of CFA holders. So I'm very curious now to look it up and read it.
Okay, thank you very much. I guess for the sake of time, we've exceeded the time, so we'll have to stop here. Obviously, I would like to thank Michel and Stefano for two excellent presentations. It was really, really interesting, and I'm sure we all learned a lot about your results. Just for information for the audience, our next webinar is going to be early June. We haven't fixed the date yet, but we know the topic. It's going to be on the greenium, on the bond and equity market. So again, something related to ESG and these issues. So we'll let you know very soon. We should fix the date very soon. Again, thank you for all of those who participated, who attended the webinar. It's always a pleasure to see you. And once again, thanks to Michel and Stefano for excellent presentation. It was an honor to have you at the webinar. And hopefully you can attend more webinars on other topics in the future. Thank you very much, everyone. And thank you, Michel and Stefano. It was nice.
Thank you, Jocelyn, very much. Enjoyed it.
Thank you very much. Thanks.
Bye.
Bye-bye.